Trade wars are easy to win, or so said Donald Trump back in 2018. But years later, the world is still reeling from the effects of the tariffs his administration imposed. In this video, we unpack the Trump tariffs, from their origin to their lasting impact on global trade, industry, and geopolitics. Before we dive into the Trump-era policies, let's clear up what tariffs are. Tariffs are taxes imposed by a government on imported goods. They're used for three main reasons: to protect domestic industries, to punish or pressure other countries, and sometimes simply to generate revenue. When a tariff is added, it makes the imported product more expensive. The idea is to give an edge to local producers by making foreign goods less attractive to buyers. But it's not always that simple. When Donald Trump ran for president in 2016, he made trade a central campaign issue. He repeatedly argued that America was being taken advantage of, especially by China. His message was simple: U.S. factories were closing, jobs were going overseas, and unfair trade deals were to blame. Trump promised to rewrite the rules of global trade to benefit American workers. Tariffs, he claimed, would force other countries to negotiate better deals. So, once in office, he began implementing those tariffs, starting what many called a trade war. Here's a timeline of some major moves. March 2018. Trump announced tariffs of 25% on steel and 10% on aluminium imports from many countries, including key allies like Canada, Mexico, and the EU. He cited national security concerns under Section 232 of the Trade Expansion Act. Mid-2018 onward, the biggest focus was China. Over the course of 2018 and 2019, the U.S. imposed tariffs on over $360 billion worth of Chinese goods: electronics, clothing, machinery, you name it. In response, China fired back with tariffs on U.S. goods, especially agriculture. American soybeans, pork, and corn were hit hard. This tit-for-tat escalated tensions and rocked global supply chains. January 2020. The U.S. and China signed a partial deal known as Phase 1, which paused further escalation. China agreed to buy more U.S. goods, but many of the original tariffs stayed in place. Trump also renegotiated NAFTA, replacing it with the USMCA, the United States-Mexico-Canada Agreement, which had more protectionist features, especially for the auto industry. So what happened to the U.S. economy and global trade? Tariffs are taxes, and companies often pass them on to consumers. Studies showed that American consumers and businesses bore the bulk of the cost. For example, washing machines and electronics became more expensive. Manufacturing slowed down. Though some industries benefited, like domestic steel, others were hurt. Manufacturers relying on imported parts, like car makers and machinery firms, faced rising costs. Many couldn't simply buy American goods because supply chains had become global over decades. Farmers struggled. China's retaliation hit U.S. agriculture hard. Soybean exports dropped drastically. The Trump administration responded with bailouts, giving farmers over $28 billion in aid, more than the U.S. spent on the auto bailout during the 2008 crisis. Tariffs may have saved some jobs in protected industries like steel, but broader economic research suggests that for every job saved, others were lost due to cost increases, layoffs, or slowed hiring. Constant tariff threats made it difficult for companies to plan. Should they move operations out of China? Should they raise prices or absorb the costs? The Trump tariffs didn't just affect the U.S. They sent shockwaves across the world. China shifted its trade ties. It bought more soybeans from Brazil and invested more in domestic manufacturing. It also deepened ties with Europe and Asia, helping form RCEP, the world's largest trade pact, excluding the U.S. Many close U.S. allies were stunned by tariffs against them. Canada, the EU, and South Korea all faced trade restrictions, and many responded with their own tariffs. Tensions rose even within NATO and G7 meetings. Companies began rethinking their supply chains. Some shifted production from China to Vietnam, India or Mexico. This trend, called decoupling, continues today, partly as a legacy of Trump's policies. Global markets became more volatile. Stock prices swung wildly based on tariff news. Global growth slowed during the peak of the trade war, with the IMF repeatedly cutting its global economic forecasts. Fast forward to 2025. Trump is back in office, and the tariff playbook is back in use. In April 2025, Trump imposed a massive 104% tariff on Chinese imports, including electronics, machinery, and textiles. He claims this is a reciprocal move to counter unfair Chinese practices. He also targeted countries like Japan, South Korea, and even the EU. The S&P 500 neared bear territory. Oil prices fell. Investors scrambled for safe assets like gold and U.S. Treasuries. Analysts estimate that these new tariffs could reduce American consumer spending power by up to $78 billion per year. Brands like Gucci and Cartier have already raised prices due to import duties and reduced consumer demand. China is exploring export controls on rare earth metals, essential for electronics and military tech, and is considering sanctions on U.S. firms. China has already imposed its own tariffs on USA. Other nations are exploring monetary policy tools, like interest rate cuts, to combat the slowdown triggered by the tariffs. This has been our look at the Trump tariffs, their rise, their reach, and their ripple effects. What do you think? Smart strategy or costly gamble? Let us know in the comments.